The market does not punish people first by taking prices down. It punishes them by compressing their nerve. That is the first truth. Most people think a bad year in the market is mainly a numbers event. Red screens, falling charts, a weak index, a correction, a crash. They think the danger lives in the percentage. I do not. The percentage is only the visible part. The real event is compression. A bear market compresses prices. It compresses confidence. It compresses time. It compresses weak conviction until people begin doing exactly the thing that permanently separates them from future wealth. They sell the spring while it is being loaded. That is what happened in 2022, and I believe that is the risk. And the opportunity sitting in front of people again in 2026, if you do not understand compression, you will misread everything that follows. You will see a market down 4.5% early in the year and think danger. You will hear about oil shocks, geopolitical conflict, tariffs, stubborn inflation, no rate cuts, AI bubble fears, and weakening technology names. And you will think the conclusion is obvious: get smaller, get safer, wait for clarity. That is what the public always says when the spring starts tightening. It sounds prudent. It often becomes ruinous because the market has a habit the public never fully learns. It loads the next cycle while people are still emotionally trapped in the current one. By the time certainty returns, a large share of the easy gains are already gone. By the time the headlines look cleaner, prices are usually much less generous. The public wants proof before action. Wealth is very often built by acting while proof still feels incomplete. That is not recklessness, that is understanding compression. Look back at 2022, the market finished down 18%. It felt historic. It felt like a full moral verdict on optimism itself. Russia invaded Ukraine, energy and food prices surged. Supply chains were hit again. Technology sold off hard. The market became obsessed with whether mega-cap growth had become too large, too expensive, too fragile. The Federal Reserve responded to inflation with aggressive rate hikes. It was the kind of year that makes average investors feel wise for doing nothing and clever for selling. And yet what came next? 3 extraordinary years of gains, not because the pain of 2022 was fake, because compression had loaded the spring. The public looked at the falling market and saw destruction. The disciplined investor saw future return being squeezed into cheaper prices. That is the difference I need you to understand. A bear market does not only remove wealth from those who panic, it redistributes future advantage toward those who keep buying productive assets, while everyone else is emotionally incapacitated. Now look at 2026. You do not need perfect historical repetition to recognize familiar pressure. In fact, waiting for perfect repetition is another way people talk themselves out of acting when the setup is good enough. You only need to identify the pattern of compression. And the pattern is already there. A major geopolitical conflict again. This time centered on Iran rather than Ukraine, but with the same essential effect that matters to markets: energy pressure, transport pressure, supply chain vulnerability, and the possibility of second-order inflation showing up in places households do not expect, until it is already in the bill. A technology correction, again, not called a tech bubble in the old language, but called an AI bubble in the new language. Same psychology, same habit of taking one of the strongest engines in the market and deciding that because expectations became too enthusiastic. Every name tied to that engine must now be suspect. Meta down, Amazon down, Microsoft hit hard, growth ETFs weaker, pure technology funds under pressure. Once again, the market is not calmly discriminating. It is compressing the whole theme under fear. And then the rate story in late 2025 and early 2026. Many investors still carried the emotional assumption that cuts would keep arriving. Then Powell made the crucial point: rates stay steady, inflation still matters, and there may only be a single cut through 2026. That may not sound identical to 2022 as aggressive hikes. But the important thing is not cosmetic similarity. The important thing is that the market was again denied the easier money path it had wanted to price. That matters. The market does not need the exact same headline to enter the exact same emotional state. It only needs to be told that the liquidity support it assumed would arrive is not arriving on the schedule it hoped. That is enough to tighten the spring. Then you add the supply chain layer, and this is where most people still underestimate what is in front of them. Oil is not just about your commute. Oil is transport. Oil is freight. Oil is machinery. Oil is agriculture. Oil is what lets the system move physically. When oil rises sharply, the economy does not experience one simple price change. It experiences an invisible relabeling of costs across thousands of categories. The public sees the gas station sign. The serious investor sees the freight system. And behind the freight system sits something even more important. Food. The source transcript pointed to one of the least appreciated dangers in the whole chain: fertilizer. Many Americans hear war in the Middle East and think only in gasoline. That is shallow thinking. Fertilizer availability and fertilizer pricing sit underneath agriculture itself. Meaningful percentages of critical fertilizer ingredients come from that region. If the supply chain tightens and costs jump 40% year over year, that is not a small side issue. That is the sort of buried pressure that can move through the economy slowly enough to be ignored at first and painfully enough to matter later. That is compression again. A price pressure that begins in one place and tightens margins somewhere else. Then tariffs add their own form of drag, not because tariffs are mystical, because they disrupt supplier networks, increase import costs, force companies to rework logistics, and inject additional friction into a system already dealing with energy uncertainty. McKinsey survey result in the source is not surprising to me. Of course, supply chains are affected when you combine geopolitical tension with tariff restructuring. Of course, costs rise. Of course, margins come under pressure. That is what systems do under friction. So now step back and look at the spring. Geopolitical conflict, energy pressure, AI fear, no easy rate relief, tariff-driven supply strain, hidden agricultural risk. This is not some random ugly quarter. This is compression. And compression is where the next cycle is either handed to you or taken from you depending on your behavior. Now I want to make something brutally clear. The market is usually in a bull state. That is precisely why bull markets are less interesting than people think. The crowd loves them because the crowd confuses comfort with opportunity. A bull market is often where people feel smart. A bear market is where some of the most important money is actually made. That sounds counterintuitive only because most people do not understand what creates long-term return. They think return is born when prices rise. That is not the full truth. A large part of return is born when you buy productive assets at compressed prices while the crowd is still emotionally unable to distinguish temporary fear from permanent damage. The public invests most enthusiastically in the expensive phase because expensive feels safe. The public becomes cautious in the compressed phase because cheaper feels dangerous. That inversion is one of the most reliable wealth-destroying habits in modern investing. If you are a new investor, this matters even more. The crowd thinks experience protects people in moments like this. Sometimes experience becomes baggage. A new investor with the right framework can actually outperform a seasoned investor with a damaged nervous system because the damaged nervous system is full of ghosts. It remembers 2008, it remembers 2022, it remembers every headline, every false dawn, every prediction that seems so plausible in the middle of the panic. So it does what anxious humans do. It waits, it wants confirmation. It wants the bottom to become socially approved. That is how bottoms get missed. Because bottoms do not arrive with a certificate. They arrive while the news still looks ugly. They arrive while confident people are still explaining why lower prices must keep going lower. They arrive while most people still call the bounce a trap. That is what happened after 2022. People sold to wait for the true bottom. The bottom came faster than they expected. Then they refused to believe it. Then they waited through 2023 because the recovery felt false. Then they waited through 2024 because the market had already gone too far to justify chasing. Then they watched 2025 extend the move and told themselves they would be ready next time. Well, next time is how you describe an opportunity while you are still managing your fear from last time. That is why I care less about predictions than systems. If you rely on feeling ready, you will almost always be late. If you rely on headlines turning friendly, you will almost always pay more. If you rely on experts to announce safety, you will almost always be buying after a large part of the spring has already uncoiled. You need something stronger than emotional readiness. You need rules. That is what most investors are actually missing. Not information. Rules. People consume endless financial content and stay strategically weak because they have no written road of their own. They react to every shock from scratch. Oil rises, they improvise. Technology falls, they improvise. Powell speaks, they improvise. Tariffs intensify, they improvise. A new geopolitical event appears, they improvise. You cannot build wealth by reinventing your philosophy every time the market becomes dramatic. That is not investing. That is emotional improvisation with financial consequences. What protects you in a compression year is not inspiration. It is a framework, a written investment policy statement, an asset allocation that already matches your life stage, a clear list of which ETFs you own and why, an automation plan that keeps your money moving according to principle rather than according to mood, a set of rules for what you do in bull markets, in corrections, in bear markets, and in high volatility periods. That sounds boring. Good. Money is usually safest in boring systems. The source transcript became a course pitch in the second half. I do not care about the pitch. I care about the buried truth inside it. The buried truth is that the best investors are not the people who know the most facts in a panic. They are the people with the fewest decisions left to make when panic arrives. That is why automation matters so much. People talk about automation as if it were a convenience feature. It is a protection against your own worst reflexes. The bear market always tries to convince you that this time discipline is naive and reaction is intelligence. Automation answers that lie by continuing to buy while you feel uncertain. It turns your long-term conviction into behavior at the exact moment. Your emotions would prefer paralysis. That is not weakness. That is design. Now let me speak directly to the second group, the source called out. People close to or already in retirement. You do not experience compression the same way a 28-year-old does. The 28-year-old needs courage and system because time is on his side if he keeps buying. The near retiree needs structure, not slogans. A person approaching retirement cannot simply chant "buy the dip" as if sequence risk does not exist. If major withdrawals begin during a sharp compression year, a portfolio can be damaged in ways that are difficult to fully repair. That is why pre-retirement and early retirement positioning must be built with more care. Cash reserve layers, bond ladders where appropriate, a withdrawal buffer. Equity exposure matched to actual spending needs rather than to aspirational bravado. A plan for what gets sold and what does not. A policy for what to do if the market drops 10, 20, or 30% right when you need income. That is what adulthood looks like in retirement investing. Not panic, not blind optimism. Prepared structure. This is another reason I dislike the simplistic internet version of buy. The dip. The phrase is directionally right and behaviorally incomplete. Buying the dip works best when the rest of the machine around it is properly designed. If your emergency fund is weak, if your debt is chaotic, if your upcoming cash needs are too near, then a market dip can feel like threat instead of opportunity. That is not because the market is evil. It is because your system was not built to absorb compression. And that is the real lesson of both 2022 and 2026. The market does not reveal intelligence first. It reveals structure. People with weak structure discover how emotional they really are. People with strong structure discover how much volatility they can survive without betraying their own plan. That is the behavior gap. And the behavior gap is bigger than almost every return gap the public spends time obsessing over. People love debating which ETF is best, which sector wins next. Whether small caps or large caps or value or growth will lead. Fine, those are worthwhile discussions. But in periods like this, the bigger issue is almost always behavioral. Do you keep buying or not? Do you sell because the market feels unsafe, or do you stay with the system? Do you change your allocation from fear, or do you execute the policy you built when you were calm? Do you let geopolitical noise override a long-term ownership framework in productive businesses and broad ETFs? Or do you understand that fear itself is often the stage where long-term entry prices improve most? That is the divide. The source transcript said it directly in a way I actually agree with. Successful investing is about building a framework on discipline and automation. That sentence is worth much more than the sales copy wrapped around it, because it is true. Without a framework, every downturn becomes a referendum on your intelligence. With a framework, a downturn becomes a test of your obedience to your own best thinking. That is a much better test. Now let me tell you what I would not do. I would not sell a broad equity allocation just because the market is uncomfortable and promise myself I will buy back lower. When the bottom appears, that is how people lose years. It sounds smart because it flatters the ego. It says I am above the crowd. I will exit the danger and re-enter at precisely the right time. Usually what it really means is I cannot emotionally tolerate compression, and I am hoping future certainty will rescue me from making a hard decision. Now, future certainty rarely comes on schedule. What usually comes instead is a faster rebound than your fear was prepared to believe. Then the mind gets trapped again. Should I buy now or wait for another drop? The wait becomes longer, then the price is higher. Then buying feels stupid because you sold lower, so you keep waiting. This is how intelligent people miss extraordinary recoveries. not because they lacked data, because they mistook control fantasy for discipline. Discipline is not selling and hoping to buy lower. Discipline is following the right system before, during, and after compression. That system can include rebalancing, it can include staged buying, it can include deliberate ETF selection, it can include tax-aware moves, it can include retirement, specific cash buckets, it can include many sophisticated features. But it must not depend on your ability to emotionally identify the bottom in real time. That is not a system. That is gambling dressed as caution. Now let us return to 2026 and the rare gift hidden inside it. The market is already negative. Fear is already spreading. People are already drawing eerie comparisons to 2022. Good. That is exactly when the spring does its most valuable work, because the crowd is once again doing what it always does during compression. It is treating lower prices as evidence that opportunity disappeared, when in fact lower prices in productive assets are the first ingredient of future outperformance. More of the market S-long. Term gains are born in stressful periods than people want to admit. Not because stress is enjoyable, because stress changes your price. That is the opportunity most people will not see until it is gone. And the people who do see it must still do one more thing. Act not emotionally, systematically. That is the part that separates the educated from the wealthy, plenty of people know. In the abstract, that bear markets can be great buying periods. Very few actually behave that way when the world is noisy enough to make inaction feel intelligent. The difference between those two groups is not knowledge. It is structure married to action. That is why I would rather have a simpler investor with a written system than a brilliant investor with no rules. The simple investor with rules keeps purchasing when the market is on sale. The brilliant improviser keeps waiting for emotional permission. The market pays the first person far more often than the second. So here is the real message of this moment. Do not ask whether 2026 will be exactly like 2022. That is the wrong question. Ask whether the market is again compressing prices under a cluster of fears that sound big enough to freeze the crowd and familiar enough to remind disciplined investors what comes after fear is absorbed. Ask whether your system is ready for compression. Ask whether your cash flow, emergency fund, and automation are strong enough that lower prices improve your future rather than threaten it. Ask whether you have a clear policy for both accumulation and withdrawal depending on your life stage. Ask whether you are consuming drama or building a machine. Those are the adult questions because in the end, investing is not a talent contest, it is a behavior contest, and compression is where the contest becomes honest. Bull markets flatter everybody. Compression reveals who had a system. That is why I do not fear this kind of year the way the public does. I respect it. I respect what it can do to weak hands. I respect what it can do to people with no plan. I respect how quickly it can convince a household that selling feels smart and buying feels irresponsible. But I also respect what it can do for the patient owner of broad productive assets. It can load the spring, it can lower the entry price, it can transfer future return away from the emotionally unstable and toward the structurally prepared. That is the gift, not a pleasant gift, a valuable one. And if you understand that, then you will stop treating bear markets like verdicts. You will start treating them like compression chambers where the future is being quietly repriced for anyone disciplined enough to keep moving while everyone else waits for the all. Clear that always comes too late. That is the door. Most people will stand outside it because the room still sounds frightening. You do not need courage in the cinematic sense. You need a written system, automated behavior, and enough clarity to understand that the spring rarely loads in comfortable times. It loads now. And whether that becomes a threat or a fortune for you will depend on one thing. Not the headlines, not Powell, not oil, not the AI bubble narrative. Whether you built something strong enough to keep buying when compression made everyone else forget what lower prices are really for.